Okay, so the last part of chapter 14, which is the last chapter that we're going to study. That's very exciting. So this is the last new content, all right? Is just sort of going over all of the ratios that we've already learned. So it's not new. We've learned little bits of them at the end of each chapter, but it does break them into a little bit of I don't know, a pattern of, or I don't know, just a way of looking at them and what they're for, I guess it breaks them into that. So we'll start with what they call liquidity ratios and measures. Liquidity is a term in finance that means cash or cashing. Okay. So the more liquid an asset, the more easily converted into cash it is. Okay. So cash is the most liquid of all assets. And by liquid, it means we can spend it on what we need to without any other conversion or wait time. Whereas if I have a building, I can convert a building into cash by selling the building, but I usually have to find the right buyer, agree upon the right price, go through a whole real estate process. It might take me months to sell a building. And so we would say a building is less liquid than something like cash. Accounts receivable is definitely more liquid than a building, but not as liquid as cash, because I still have to get the people who owe me to pay me, right? But I could probably get that done within 30 days or so. All right, so liquidity ratios just measure how liquid we are or how easy it is for us to spend the money we have. So there's three. You don't need to worry too much about the categories they're in at all. In fact, on the final exam, anything we have to do with these, I'm not going to make you memorize it, so you can have a list of these ratios. I just don't see the value in memorizing all of them. Like never have I ever in my life as an accountant been like asked while I was trudging through the Gobi Desert of China to calculate the accounts receivable turnover of a company without the aid of, Google. So we don't have to memorize these, but we do need to know how to work them, So working capital, current ratio, quick ratio, those are the most liquid of assets. Again, we've seen these already earlier in the class. Accounts receivable turnover, days sales and receivables, and then inventory turnover and days sales and inventory. So that's 3, 4, 5, 6, 7 different ones. So this is helpful. It's a little reference list of each of them and their formulas. In the let me show you real quick in Canvas. Go to our class. Go to modules. Wait half an hour for it to load. In my additional study resources for chapter 14, right here, no one even looked up, so apparently you don't care. That's awesome. I got some video resources, some web-based resources, and then a couple of links here that will help you if you want to have any additional information on these. All right, so let's just do a few problems with them, and I think you'll see that they're not bad because, like I said, we've already done them a little bit in the course. All right, so we have a bond indenture for a 10-year 9% bond. Required working capital of $100,000, a current ratio of 1.5, and a quick ratio of 1.0 at the end of each calendar year until the bonds mature. So it tells us all that information. Then it gives us the current assets, current liabilities, current ratio, and the quick ratio. And it says, find errors in the determination of the 3 measures of current position analysis. Then provide the correct amounts below, if required. Round ratios to 1 decimal place. All right. So this is a lot of talking to tell us we need to figure out the current ratio, the quick ratio, and the working capital. Okay. So the formula for working capital is simply current assets minus current liabilities. So we're going to look at these current assets, and we can see there's some errors here in the sense that they have all of these different assets here, and some of them aren't current assets, like property, plant, and equipment. That's not a current asset. Intangible, that's not a current asset. Okay. So let's see. We're just going to do cash. So probably the hardest part about these problems is recognizing, like, well, what are current assets and what are current liabilities. So cash is a current asset. Temporary investments is current. Accounts receivable, inventories, and prepaid expenses. Those are all of our current assets. And then our current liabilities, we have accounts payable and accrued liabilities, which are, those are correctly current liabilities. So we're just going to add up all of these current assets. We pull up a calculator here. 102,000 for cash, plus 48,000 for temporary investments, plus 120,000 for accounts receivable, plus 36,000 for inventory, plus 24,000 prepaid expenses. So I get 330,000 for the current assets. And the current liabilities, like I said, those are correct. So we have current liabilities of 300,000. So our working capital is just our current assets minus our current liabilities. That gives us 30,000. So the error is that they included intangible assets and property, plant, and equipment in their calculation of current assets. So all working capital means is the short-term money I have available, current assets, minus the short-term debts I have to pay, is the amount of money I have to work with, right? Because the rest of those assets, short-term or current assets, are spoken for. I'm going to have to use them to pay off the short-term debts. The current ratio is just the current assets divided by the current liabilities. So 330,000 divided by 300,000. That's all we do to figure out the current ratio. I get 1.1. When we're analyzing this, think about it. If it's current assets divided by current liabilities, or the ratio between the two, right? That if my current assets equal my current liabilities, it'll be a 1. So anything greater than 1 shows that I have an excess of current assets over current liabilities, or I have more current assets than I have current liabilities. Anything less than 1 would mean I have more current debts, than I have current assets. Typically, like a bank who's deciding whether or not to loan you money, they'd like to see you have a current ratio of about 2, have about twice as much current assets as you have current liabilities. But of course, all the businesses complain and say, if I had that, I wouldn't need to borrow money, right? So that's the world of finance. The banks don't want to lend it to you till you're completely safe. And the people who are borrowing it are like, if I was completely safe, I wouldn't want to borrow. So that sounds like life. And then the quick ratio is it's like the current ratio, but it has let's see. We don't include certain current assets, okay? And we don't include assets that we, what's the word? That we really have to replace or that aren't really going to ever turn into cash. So to do the quick ratio, it's the current assets minus any inventories, right? Because if we were to convert all those inventories to cash and then not replace them, we're out of business. So really, we have to plan always to keep inventory so that we have something to sell our customers. And then minus prepaid expenses, because prepaid expenses don't really turn into cash. They're just paying for something like our prepaid rent or our prepaid insurance. We're not going to ever get cash out of it. So current assets or quick assets are really our cash, our temporary investments, and our accounts receivable. Just those three. So I get 102 plus 48, which is 150 plus 120. I think gives me 270. Does that sound right? Divided by the current liabilities, which are 300,000. That gives me 270 divided by 300,000 gives me 0.9, right? So then there's the question, is the company satisfying the terms of the bond indenture? In other words, they agreed to meet certain terms, which it told us up front here, that they would have a current ratio of 1.5, working capital of $100,000, and a quick ratio of 1 at the end of each calendar year. And they don't have that, right? They've got working capital of 30,000, current ratio of 1.1, and a quick ratio of 0.9. So no, they're not satisfying the terms. So really all of these problems, you just have to know the formula and you just work the formula. Okay. Sometimes the harder part is identifying, is that a current asset or not? Not the math itself. Although you've seen that with a lot of accounting, right? The math itself isn't hard. It's the like identification of what belongs with what grouping. All right. And then accounts receivable analysis. So the following data are taken from the financial statements of Sigmund Inc. Terms of all sales are 210, net 45. Do you remember what that means? It's that there's a 2% discount if you pay within 10 days. If not, then you owe the full amount before 45 days. Okay. So here's our accounts receivable at the end of the year for 3 different years. Our sales on account for 2 years. For 2022 and 23, determine the accounts receivable turnover and the number of days sales and receivables. Round interim calculations to the nearest dollar, etc. Okay. So our accounts receivable turnover is just our sales divided by our average accounts receivable. And to find our average accounts receivable, we would just take the accounts receivable at the beginning of the year plus the accounts receivable at the end of the year, divide by 2. That gives us an average for the year. Okay. So for 2023, we would just take the accounts receivable at the beginning of the year, which is the same as the accounts receivable at the end of the previous year, okay, plus the accounts receivable at the end of the year. And that'll give us the denominator, that'll give us our average accounts receivable. And then we'll take sales and divide it by that. So I'll do 5,637,500 divided by 725,000. plus 150,000 divided by 2. I get 8.2. I'll do the same thing for 2022. I'll take 4,687,500. Divide that by 650,000 plus 600,000. 2. And I get 7.5. So what does that mean? It means how many times in a year do I sell an amount that is equal to my average accounts receivable? All right. Accounts receivable is what's owed to me. How often am I doing my sales? So in 2022, my sales were 7.5 times greater than my average accounts receivable. Or in other words, I sold an amount equal to my average accounts receivable 7.5 times during the year. In 2023, it was 8.2. So my sales going up relative to my average accounts receivable is typically a good thing, right? More sales relative to what I'm owed. Okay. So this is one of those that the number getting higher is a positive thing. Okay. So then the number of days sales in receivables is we just take our average accounts receivable divided by our average daily sales. Find our average daily sales. We take the sales divided by 365. That would give us the average daily sales. So I'll take the average accounts receivable for 2023. Here, I'll just do it again. So, sorry. Parentheses 725 plus 650. So there's my average accounts receivable divided by my sales, 5,637,500 over 365. And I get 44.5. What does that mean? It means on average, I'm collecting, or a dollar that's in receivable, the dollar owed to me takes me about 44.5 days to collect, is what that means. And it's on average. It's not that this guy pays me off in 44.5 days. Some people might pay me off in 15 days. Other people might pay me off in 60. This is an average. Okay. And then to do it for 2022, again, we're going to take our average accounts receivable. So so 650,000. No, silly use. 650,000 plus 600,000 or 2. That's my numerator. Divided by my sales for that year, 4,687,500 over 365 to get my average daily sales. And I get 48.66. Oh, 48.7, sorry. So if what this is measuring is on average how long it takes me to collect money, then the faster I can collect the money that's owed to me, the better. Okay, so this is one of those where lower is better. So both of these measures are showing an improvement from 2022 to 2023. my turnover is getting higher, which means my sales my sales over my average receivables is getting higher, and the number of days on average it takes me to collect is getting lower. So I'm going to say the collection of accounts receivable has improved. This can be seen in both the increase in accounts receivable turnover and the decrease in the collection period. So again, in the real world, most accounting software, if we have accurate data put into the accounting software, can produce these reports for us. We're not calculating them by hand. But I think it's important, and I think the reason the textbook publishers have these problems where they make you do it by hand is you'd have to be able to look at that and say, like, I recognize what's happening there, right? That this has to do with the amount that's owed to you and the amount of sales you have. And the more quickly you can collect that, the better. And so as you collect quicker, that number's drop. You have to understand the measures. So for most of us who are going into business and not into accounting, do I need to memorize these things? Not really. For someone who's going to say work with these reports all day long, well, of course, right? You're going to work with it all the time and you'll get really comfortable at just noticing trends in the reports. That's why I'm like, don't memorize it, but try to get an idea of what we're looking at here. Okay. All right. So after our liquidity ratios, we have what are called solvency ratios. Solvency usually has to do with liabilities. When you say a company is solvent, it means they are able to pay their debts. Okay. So there's three that are covered throughout the class: ratio of fixed assets to long-term liabilities. You can guess that that's probably the fixed assets divided by the long-term liability. The ratio of liabilities to stockholders' equity. In other words, what's your debt divided by your equity or stake of ownership as owners. And then the times interest earned ratios. So there's the formula for those three, if anybody wants them, without having to look them up later. So fixed assets to long-term liabilities is just fixed assets divided by long-term liabilities. And you'll see that's fixed assets net, which means their book value, which means their cost minus any accumulated depreciation on them. The ratio of liabilities to stockholders' equity is exactly what it sounds like. Total liabilities divided by total stockholders' equity. And then your times interest earned is just your income before income tax expense plus interest expense divided by interest expense. That's what it is. All right, that's the formula. So we'll look at another problem. Again, not crazy hard once you know the formulas. So here's following data taken from the financial statements of Hunter Inc. for December 31st of the most two recent years. You can see all of those things on there. The income before tax expense was $480,000. And $420,000 for the two previous years. Determine the ratio of liability to stockholders of liabilities to stockholders' equity at the end of each year. Okay. So I'm going to look at this and just be like, what's liabilities? Accounts payable is a liability. Current maturities of bonds. Bonds payable. Those are liabilities. Common stock. Paid in capital in excess of par and retained earnings. Those are the equity accounts. So I'm just going to take these, the top three, add them up, divide them by the bottom three. Okay. This one's an interesting ratio because it's total liabilities divided by total equity. We learned at the very beginning of the class that assets equal liabilities plus equity. So the two of these together equal our assets. So when we get this number, we'll say if liabilities equal equity. In other words, if half of my business was owned by me, the owner, and the other half was owned by the bank, so to speak, by someone I owed money to, then I would have a ratio of 1. Which means I would have, like, if I had assets of $1 million, 500,000 would be liabilities, and 500,000 would be equity. As this number gets higher, it means I have more debt relative, more debt relative to the amount of equity I have. Okay, so higher is kind of worse. More of my business is owned by the bank and less by me. If this number is lower, it means it's more equity and less debt. So, like I said, we've identified the top 3 as liabilities, and the bottom 3 as equity. So I'm just going to do parenthesis 924 plus 200 plus 1 million. There's my numerator divided by my denominator, 250, oops, plus 1,250 plus 86. And I come out with a 0.9. In the previous year, I had 800, 200 plus 1,200,000. There's my numerator divided by the denominator of 250 plus 1,250,000. 1.1. So remember I said lower is better, right? So looks like we're improving a little bit. Still not great though. Still nearly half of our company is of our assets are owned by debt, right? All right, determine the times interest earned ratio for both years. So times interest earned is our income before income taxes plus interest expense divided by interest expense. So let's see what we have here. Oh, there it is. Income before income tax is 480,000 and 420,000 in the current years. And then our interest expense, we're going to have to figure out. This one's a little bit harder because we see that we have accounts payable. Accounts payable you don't usually pay interest on, but these bonds we do. So if I have 200,000 of current maturities in bonds plus another $1 million in non-current maturities, means I owe $1.2 million on the bonds, and it's at 10%. So what's the interest for 1 year? 1.2 million at 10%. 1,200,000 times 0.1, 120,000. Yeah. All right, so I'm going to take my income before income tax, 480,000, plus my interest expense, 120,000, and then divide that by the interest expense. And that's going to give me 5. What does that mean? It means my operating income or my net income before income tax expense plus interest expense is 5 times greater than my interest expense. Really, it's a measure of, am I earning enough to cover my interest costs? And I'm earning 5 times more than what my interest costs are. We'll do the same thing for the previous year. Again, we'll look at the bond. So we have $1,400,000 total of bonds, which is 1,200,000 plus the current amounts of bonds, times 10%, which is 140,000. And then our income before income tax is 420, so I'll do 420,000 plus 140,000 divided by 140,000. And I combine 4. So the ratio of liabilities to stockholder equity has improved. And the number of times bond interest charges were earned has improved from the previous year. These results are a combined result of a blank income before income taxes, larger, and a smaller interest expense or lower interest expense. So they're making more profit and their interest expense is dropping because they're paying off some of their debt. So their situation's improving. So for those of you who are like interested in going to the finance side of business, a lot of these measures get used there, especially when trying to determine, well, what businesses should we be investing in? What businesses should we be, depending on which part of the finance side, should we be lending money to or not lending money to? Again, though, this is brand new. I'm just now showing it to you. In those situations, usually you go through business school, then you get hired, then you get on the job training, and then you start working with somebody who's more senior, and so you get very comfortable with these before they're letting you make serious decisions that would could blow up the business or something. All right, so don't worry. Someone's like, I just want to do HR, man. I don't need these numbers. We have profitability ratios. They measure our profitability. Remember, profit, another word for profit is net income. So this has to do with revenue and expenses. Since it's revenue minus expenses gives us net income. And a lot of times it's our profitability relative to other things. So there's 1, 2, 3, 4, 5, 6, 7, 8 of these. And I'll show you, there's all their different formulas. Asset turnover is just our sales divided by our average total assets. Return on total assets is our net income plus interest expense divided by our average total assets. Usually anything that says return on means to take net income divided by. Okay, so return on assets would be like, well, how well are we using the assets we have to generate profits? Return on stockholders' equity, net income divided by average total stockholders' equity. It's a good way for us to compare two companies, right? We could say, well, they both have similar profits, but one has a much higher stockholders' equity. And so it's going to have a different return on equity. Earnings per share, you've probably heard of sometimes, like if you're watching the stock market thing, which is just our net income divided by the number of shares. Price to earnings ratio, the market price divided by the earnings per share, etc. All right. So again, we'll look at one final problem here. And again, it's going to give us a ton of information. And then want us to calculate 6 different measures. So here we go. So we have, what do we have here? Property, plant, equipment, liabilities. So it's just giving us a bunch of information from the balance sheet. And also giving us some information from the income statement, like the net income. So the ratio of fixed assets to long-term liabilities. So I'm going to look at my balance sheet here. Fixed assets is another term for property, plant, and equipment. So I'm going to take my fixed assets or my property, plant, and equipment, 3,200,000, divided by my long-term liabilities. You can see under my liabilities, I have current liabilities, and then I have a note payable due in 15 years. So that note payable is the one that is my long-term liability. So I'll take the property, plant, and equipment, 3,200,000, divided by 2 million, and I get 1.6. So that's my ratio of long-term assets or fixed assets to long-term liabilities. Ratio of liabilities to stockholders' equity. I'm just going to take my total liabilities. Divided by my total stockholders' equity. The total liability is 3 million. Total stockholders' equity is 5 million. 0.6. Asset turnover. Remember, we did these, a couple of these already, right? So we do average sales. Oh, I'm sorry, sales by average total assets. So here's my sales. And then somewhere it's gonna have to tell me. Oh. It's a new one. So here it gives me the total assets at the beginning of the year were 7 million. What were my assets at the end of the year? Sorry. So the long-term investments totaled 300,000 throughout the year, and the total assets were 3 million, and were 7 million at the beginning of the current fiscal year. Determine the following. I have the property, plant, and equipment, but I don't know. Oh, but you know what I do have? I do have my total stockholders' equity. And I have my total liabilities. So I can add those together to be my total assets at the beginning of the year. Or sorry, at the end of the year. So that's 8 million. Gotta figure it out. So asset turnover is our sales divided by our average total assets, not including let's begin this. All right. So our sales over our average total assets. And for average total assets, we don't include long-term investments. All right. So our sales for the year were 18,900,000. And our average total assets are going to be our assets at the beginning of the year, plus our assets at the end of the year. So, and then minus our long-term investments, which I think it told us right here. Okay. So, okay, that's okay. So our assets at the end of the year. So their assets at the beginning of the year, right here, 7 million. And our assets at the beginning of the year, it doesn't give us, but it does give us our total liabilities and our total stockholders' equity. We know that assets equal liabilities plus stockholder equity. So if I had 500,000 in stockholder equity and 300,000, or sorry, 5 million in stockholder equity and 3 million in liabilities, that means I had total assets of 8 million. That's what was confusing my brain. Minus the long-term investments, which it told us were 3 million. All right, so there's our whole formula. No wonder I was having a hard time doing that in my head. I had to figure out where all that stuff came from, right? Again, the math's not hard. It's like figuring out where it all comes from. So that denominator then, so we're gonna say this is 18 million on the numerator, 900,000, yes, divided by 7 million plus 8 million divided by 2.
Thank you.
Minus 3 million.
Yeah.
That did something weird. All right.
Yeah.
Divide that by 2. Minus 3 million. So our denominator is 4,500,000. So we're going to do 18,900,000 divided by 4,500,000. That was a lot of work to get to that one. 4.2. Our return on total assets is just our net income. We add back in interest expense, so net income plus interest expense divided by average total assets. So again, here we have net income 930,000, interest expense of 120. So 930,000 plus 120,000. And then we divide that by our average total assets, which was the 7 million plus 8 million divided by 2. I came up with 0.14. Sorry, I hit enter one too many times. 0.14 for 14%. Return on stockholders' equity is our net income divided by our average total stockholders' equity. So we have our total stockholders' equity. There's our stock and our retained earnings. So this one's a little weird too, because to get our beginning of the year stockholders' equity, we're going to take preferred stock, common stock, because it says there was no change during the year, plus the balance at the beginning of the year. That'd be our stockholders' equity at the beginning of the year, plus preferred stock, common stock, balance at the end of the year, which would be our end of the year, divided by 2, would give us our average stockholders' equity. Okay, so I'm going to say 4,570,000 plus 5 million divided by 2. There's our average stockholders' equity of 4,785,000. And then we're going to divide our net income, which was 930,000, by 4,785,000. So 930, oops, divided by 4,785,000 gives us 19.4%. Finally, our return on common stockholders' equity is our net income minus our preferred dividends divided by our average common stockholders' equity. So net income, 930,000. Minus our preferred dividends, which were 100,000. That gives us 830,000 is the numerator, divided by our average common stockholders' equity, which we just figured out a minute ago, and I don't feel like going through all over again, but we can if we want to. But it was 3,785,000. Divide that by 3,785,000. And that gives us 21.9%. All right. Sorry about that. I got hung up on that one, and then it took me a couple extra minutes. So, bottom line is this, guys. The math's not hard, but the digging out all the information from the information it gives you is the hard part. So, use the formulas. Don't try to memorize all of them, but be prepared to have to dig information out and understand how to do that. Does that make sense? That's plenty for one day. Head's probably hurt, and just see you tomorrow. Yeah, I'm walking out.